So welcome to everybody. I'm very pleased to start this series of web seminar related to the European Financial Architecture RPN at CEPR. And today the topic is climate policy and the role of finance. We have two speakers. One is Marco Pagano and the other is Zach Sotner, and we are organizing ourselves in two rounds. So the first will be Marco Pagano that will present his work, and then there will be space for questions. So I'm asking to you already through his presentation to write your question in the Q&A chat. There is also the possibility to ask clarification questions. And then, we will have, I will open the floor and there will be the discussion. And then we will have, in the second part, Zach that will present his, let's say, part of the seminar. And we will have, again, the possibility to ask questions. So let me start. So the first part will be by Marco Pagano. I'm sure that everybody knows him, but just to to introduce him, he's a professor of finance at the Department of Economics and Statistics at the University of Naples, Federico II, and he's also the director of the Naples PhD in economics. He's a research fellow, of course, of the CEPR, but also of the Center for Studies in Economics and Finance, and also at the Einaudi Institute of Economics and Finance. Marco is working on a lot of different things. So clearly he's working in banking, in corporate finance, in market microstructure, and now he's also very interested on topics related to macro finance and macro law and labor economics. So I'm very happy that, he proposed to present his new work. So Marco, the floor is yours. Thank you very much.
Okay, thank you very much, Loriana, for this nice introduction. Let me share the screen. Okay, can you all see it?
Yes, very good.
Okay, so the topic of this paper is a policy proposal. It's about issuing a new European climate bond, and this is joint work with Irene Monasterolo at Utrecht University, Antonia Pacelli at Toulouse School of Economics, and Carmine Russo, who is at the University of Naples, Federico II. And the paper underlying this presentation is available on SSRN at the link listed below. So, we all know that climate transition is an urgent need, that postponing it would have direct consequences for the economy and society. And for instance, it is estimated that postponing it after 2030 in the euro area alone would lead to over 12% real GDP loss by 2050 compared to a timely introduction of a carbon tax. However, we also know that it is very costly. It's a very costly policy, so that makes the issue of its timing quite difficult. The global funding needs are estimated to be between 4.5 and $5 trillion per year, according to the Climate Policy Initiative, and this includes both the expenses for climate mitigation, that is decarbonization, and for climate adaptation, that is increasing the resilience of the economy to natural disasters linked to climate, such as coastline defense against sea level rise, water management to prevent floods, and so on. Now, this paper argues, and my presentation today argues that for Europe, this challenge, however, is also an opportunity if we face it via joint issuance of EU climate bonds to be funded by EU carbon fiscal capacity. Now, what do we mean by carbon fiscal capacity? I hope this will be clear by the end of this talk. So in terms of topics that I will cover, I will start by giving you some information about what may be called the EU climate investment gap. That is the shortfall between how much money is needed for climate policies over the near future and how much money has already been budgeted in the European Union. Next, I will argue that not only designing, but also funding climate policies at the EU level is far more efficient than doing so at the national member state level in the European Union. And I will try to convince you that jointly issuing a EU climate bond can help in this funding of the shortfall of EU climate investment. So how big is this shortfall? What may be called the EU climate investment gap. Now, mitigation expenses are estimated with a certain amount of precision. We know that we will need approximately 58 billion euro per year to expand the Europe electric grid to connect non-fossil fuel production sites with places where energy is going to be consumed, and we are going to spend about 336 billion per year for energy system investments. Adaptation expenses are far more imprecisely estimated. The range of forecasts go from 158 billion per year to 518 billion per year, because there are no precise estimates of the adaptation investment needs by country and sector. The overall investment need therefore range between 550 billion per year and 912 billion per year over the next decade. The official estimate by the EU Commission is in the middle of this range. So according to the European Commission, EU 27 must invest over 700 billion per year to achieve net zero emission by 2050. This is the so-called Green Deal target. And how much of these 700 billion per year has already been budgeted? Roughly half. Essentially, the budget of the European Union for climate policies between 2021 and 2027, so the current 6-year plan, plus the next generation EU funds allocated to climate policies, translate into about 330 billion dollars per year for mitigation, adaptation, and cost of natural disasters. So the gap, if we take the central estimate for the investment needs, which is, as I said, 700 billion per year, the gap of these investment needs relative to the budgeted resources, which are 330 billion per year, is 370 billion per year. Of course, this must be taken not with a grain of salt, but with a kilo of salt, because there is, as I mentioned already, a wide range of estimates for adaptation needs. If we take the upper bound, the gap would rise to almost 600 billion per year. Now, one could hope that this gap could be at least partly covered by national member state budgets, but we should not be too optimistic about this, because so far European governments have spent far less than this amount. In 2019, they spent 90 billion on climate investment, so less than 1/4 of this shortfall. Okay, so these are, in a way, this points to the fact that there is a lot of money still to be found, so to speak, to face these climate investments. Now, next point I would like to argue about is who should design climate policies and who should fund it in the European Union. And there is a strong argument for doing this both designing and funding climate policies, not at the national level, but at the supranational level. That is at the level of the EU Commission. In designing climate policies, national standards are likely to lead to inefficient targets because each country has no incentive to account for cross-border externalities, and this tends to lead to insufficient spending on mitigation. Moreover, less regulated countries tend to attract carbon-intensive activities, leading to regulatory arbitrage, and this has been much explored, this topic, the so-called topic of carbon leakage, and there is empirical evidence supporting this. Not only national standards would lead to inefficient policy targets, but a national implementation of these standards is likely to lead to less efficient monitoring of climate investment policies. And the reason is analogous to that why the implementation of bank supervision, prudential bank supervision in the euro area was too lenient when done by national central bank, and this led us to create the SSM as a kind of federal, so to speak, prudential authority in the euro area. By the same token, national implementation, national monitoring of climate investment policies may expose national authorities too much to national pressure groups compared to what a supranational agency would. There are arguments for not only having the design of climate policies be at the supranational level, but also the monitoring of the implementation of these policies to be at the supranational level. There are also arguments to support that also the funding of these policies should be at the European level rather than mainly at the EU member state level. And the argument is that fiscal capacity, at least in some EU member states, is insufficient, especially considering that the EU fiscal compact that is being restated in the European Union is going to further constrain the fiscal capacity of member states. So this may lead to considerable underinvestment, at least by some member states, but this would have, again, spillovers for the reasons I was mentioning before, not only in terms of climate spillovers, so cross-border impact of emissions, but also in economic terms, because countries that underinvest for adaptation needs would expose themselves to a higher frequency of natural disasters, which would limit their growth and therefore their imports from the rest of the European Union, and even expose potentially these countries to sovereign crisis, which have, as we have seen in the past, potential spillover effects to the rest of the Union. So efficiency not only requires joint design of climate policies and monitoring, but also joint EU-level funding of these policies. And this is increasingly recognized, as you may have seen in newspapers on the web lately, in the policymaking community in Europe. For instance, Mario Draghi, here I'm quoting from a recent article by him, argues that Europe now must confront a host of supranational challenges, climate being one of them and defense being another, and the digital transition being a third one. And then he adds that Europe neither has a federal strategy to finance how to cope with these challenges, nor national policies take up the mantle. Without action, there is a serious risk that Europe underdelivers on its climate goals. So, as you know, we already have overcome the taboo of joint issuance of climate EU bonds, the joint issuance of these bonds. Now it is increasingly recognized in the policymaking community that we may need to actually do this, not temporarily, as it has been one-shot level, as it has been done in the next generation EU policy, but also on a more stable basis. Now, so this leads me to the central point of this presentation, the joint issuance of EU climate bond. And here, just to set the stage here, let me tell you a little bit about carbon pricing in Europe. What is the current status quo in the European Union? We have two types of carbon prices, if you want, carbon taxes. We have national level carbon taxes. As you can see, these are the blue bars indicate the carbon tax rate in the different countries. As you can see, Scandinavian countries have the highest, but they vary widely across countries. And then we have the emission trading system allowance price, which is an implicit price, an implicit carbon tax, if you wish, which is charged to the sectors that are regulated directly by the European Union. The European Commission issues allowances that companies can buy if they want to emit greenhouse gases. And as you can see, this is a single price, and it is higher than the carbon tax rate in most of Europe, except Sweden. The sectors and the firms that are subject to the ETS price are exempted from the national carbon taxes. So this is the current situation. Why I'm saying this? Because the first step of our proposal is to extend the ETS, so expand the scope of the emission trading system to all industries and all countries, so as to have a single carbon price in Europe, which is, of course, efficient relative to having different ones, and also to pre-announce a target path. This should be done by the European Union, that is actually already selling these allowances, to target a certain path for carbon price according to an objective set on the basis of science, by managing the supply of carbon allowance so as to target this price. This would have the benefit, first of all, of reducing transition risk, because essentially firms and households would have a predictable path of carbon prices to consider in their decisions, and effectively the seller of these carbon allowances would regulate, essentially would manage the supply of these allowances very much like a monetary authority manages the money supply, so as to target a certain interest rate. So that's the first element of our proposal. Why is this important? Because insofar as the European Commission, which is selling these ETS allowances, is enabled to retain the revenues from this carbon tax, this implicit carbon tax, essentially the revenue from the sale of these allowances, rather than rebating it to the national governments as it is currently done, this creates a fiscal capacity that can be used in the future in order to issue bonds by the European Commission. So the European Commission would be able to issue bonds servicing the interest and capital of these bonds effectively by the ETS sales revenue. So this would create a pool of fiscal capacity at the federal level in the European Union. Notice that this the European Commission is already the seller, the issuer of these allowances. Of course, what would be needed is that the member states should agree to leave this revenue going forward in the hands of the EU Commission. If the issuance of these bonds is entrusted to the European Stability Mechanism, which is the natural authority at the EU level to issue such bonds, the issuance of these bonds would also benefit from a guarantee given by unused ESM resources, which are currently 90% of the total. So the cost of servicing this climate Eurobond would benefit from three aspects. First of all, would benefit from the green nature of this bond. So insofar as many investors, especially institutional investors, are more inclined to buy green assets than brown assets, they will be willing to pay a higher price, therefore, to include these bonds in their portfolio at a lower yield. Second, it would benefit from the sovereign nature of the bond because it would be backed directly by resources that are in the balance sheet of the European Union rather than off-balance sheet resources that are provided to the European Commission by the member states, as is currently the case with Next Generation EU bonds. And finally, the bond would benefit from the AAA rating of the ESM and by its potential guarantee. In this sense, this bond can be expected to be purchased by investors at a lower yield than Next Generation EU bonds. Next Generation EU bonds have a relatively low yield, but not so great, in the sense that the current yield of Next Generation EU bonds is above the German one, and by now it's already also greater than the French one. But this, according to many market intelligence, is related to the fact that these bonds have been issued like a kind of one-shot experiment, essentially with no rollover. We know that they're not going to be, issued on a stable basis, and also they have been issued in relatively low volume. So therefore, they have low liquidity. Moreover, they are, according to many, not perceived as truly sovereign assets because, as I said, they are serviced with resources that are supposed to be transferred by national member states to the Commission. And finally, they are placed mainly by syndication, which is notoriously much more expensive than by auctions, which is the way normally public debt is placed in financial markets. Since the EU climate bond would differ along all of these dimensions from the Next Generation EU bonds, because it would be issued regularly with high volumes and therefore high liquidity, would be backed by EU resources in the budget of the European Commission, and would be specifically targeted to the funding of climate policies, and so would be essentially perceived as green bonds, and would be placed by auctions. One could expect them to be accepted by investors at lower yields. Now, the final point I would like to make is how much of these climate bonds could the European Union issue. It would be not very useful if, we conclude that, yes, the fiscal capacity, so to speak, which is created by the sale of ETS allowances is there, but it's small. So let's try to understand how big, how large this fiscal capacity might be. And to do this, we have taken data which are essentially forecasts that have been made by scientists that have produced integrated assessment models, that is dynamic general equilibrium models that produce projections for emissions and all other macroeconomic variables based on certain scenarios about policy. And we have essentially taken from these models forecasts of the level of emissions that would be in equilibrium produced by the economy for alternative paths of carbon prices as determined by policymakers. So we consider 4 such scenarios. These are the names that the NGFS, which is the Network for Greening the Financial System, this think tank has produced. One is the below 2-degree scenario, which is a kind of virtuous scenario where all countries gradually increase the stringency of climate policies, giving a 67% chance of limiting global warming to below 2 degrees by the end of the century. current policies, which is essentially keeping carbon prices exactly where they are, which would lead to almost 3 degrees by increase in global temperatures by the end of the century. Another scenario, which is called fragmented world, where essentially there will be not only delayed but divergent climate policy responses across countries globally, leading to high physical risk and also to high transition risks, and a temperature of 2.3%, an additional increase of temperature of 2.3% centigrade degrees by the end of the century. And finally, a delayed transition scenario by which we don't do anything until 2030. And then we essentially increase carbon taxes throughout the world very severely, so as to stay below 2 degrees by the end of the century. So it's a case in which the carbon, the envisaged path of carbon prices is very unstable. It's first too low and then very high. So under these scenarios, okay, this is a diagram that tells you what is the structure of these models, but I have no time to go over it. Let me just give you like the bottom line. Essentially, these are the forecast level of emissions corresponding to each scenario. So each of these lines tells you what is the assumption regarding the carbon price in each of these scenarios. For instance, it is low and rapidly increasing, as I said, in the delayed transition, the green line. It is flat at the current level in the current policy scenarios, and it is intermediate in the other two. And on the right, you see the Kyoto greenhouse gas emission levels corresponding to each of these levels, which is produced by the model. As you can see, the level of emission is highest in the current policy scenarios, because there we keep the carbon price relatively low, actually very low at the current level, whereas it is lower in the other scenarios. It's particularly unstable in the case of delayed transition. So what we do is we simply multiply carbon prices by the forecast emissions to get an idea of how much within the euro area, for the euro area countries, what would be the level of revenues that the European Commission could count upon in each of these scenarios. And as you can see, even though some of these policies forecast, actually assume relatively high carbon prices, for instance, this is the case in the below 2 degrees scenario, the blue line, still the revenues will be considerably high, because even in that case, there would be a sufficiently high amount of emissions so that the product of the two estimated revenues would still be high towards the end of the century. So there is a rather large and amount of revenues that they don't go essentially to zero, even though you charge, even in scenarios where you charge a considerably high carbon price. And so what do we do to get an idea of the magnitude of the fiscal capacity that is associated with these policies, with the sale of essentially emission allowances? We take this data for emissions and for carbon prices. We compute the revenues, essentially the product of the two. We convert it from dollars into constant euros, and compute the present discounted value. In computing the present discounted value, of course, we have to choose interest rates, and we use the real interest rate inferred from real bonds issued by the US government in the United States, the so-called TIPS rates. Now, this is just to get an idea of the magnitude of the revenues. And here is the result. Essentially, what we find is that the present discounted value of these revenues is considerably high if compared, for instance, with the current resources that have been allocated by the European Commission. I mentioned before the current allocation is $2 trillion, 2 trillion euro in the current 6-year budget for climate actions. and 2.22 trillion is the gap that the corresponding 6-year climate investment gap. As you can see, even in the scenario with current policies where the so-called EU carbon fiscal capacity is lowest, it would exceed both of these, well, it would exceed the already budgeted resources. In the case, for instance, of fragmented world, in this scenario, the amount of resources that would become available by issuing these bonds would be 6 times as large. So this is to say, you know, there is a considerable fiscal capacity that could be tapped by issuing these bonds. Let me conclude by adding that there would be considerable financial benefits, not only climate policy benefits from issuing these bonds. First of all, it would be a cost-efficient way to fund these policies relative to issuing debt at the national level, because this asset would be perceived as a safe, green, and highly liquid asset at the euro area level. And moreover, this could become the essentially the backbone. This asset could become the backbone of the essentially an integrated European financial market. So it could help this safe asset could help us making progress towards the so-called capital market union in the European Union. It would also help the European Union in responding to competition from the US and China to attract investments for the low carbon transition. So essentially to counter, say, the Inflation Reduction Act that has been is attracting European companies active in the low carbon transition to the United States with huge subsidies. It would also be potentially an important policy instrument for monetary policy, because it is a kind of market neutral bond that would help the ECB perform open market operation collateral policy without having to buy a basket of individual countries, buying or selling a basket of individual countries bonds, and would be therefore a way also to green the ECB monetary policy without jeopardizing its primary stability, price stability objective. And finally, it may avoid the European Union, and particularly some member states in the European Union, from being trapped in inefficient equilibria with low climate investments and bad macroeconomic performance. Because if governments in Europe invest too little on climate action, this is going to generate a low resilience of our economies to climate disasters. This is going to reduce GDP growth and therefore fiscal capacity, which in turn could lead to insufficient resources for climate action investments. So there is a potential negative feedback loop, if you wish, feedback loop that could trap us in a kind of low climate action investment, low macroeconomic performance equilibrium. There is also a potential financial climate feedback loop added to this real feedback loop, in the sense that low fiscal capacity arising for low resilience to climate disaster could also lead investors to have very pessimistic expectations about the solvency of national governments, and therefore could lead to potentially a sovereign crisis due to an increase in sovereign yields arising from these pessimistic expectations of investors. So in a way, issuance of these bonds could, by enabling the European Union governments to undertake the right level of climate action investments, could stave off these kind of traps. So just to conclude, we started saying that climate action is urgently needed, but it is also very expensive. Now, in the EU, we could fetch the resources that are needed to face these climate policies by essentially by using the revenues from the sales of these allowances, of these emission allowances, which are already issued by the European Commission to service these bonds. And these bonds could in turn help us to front load the investment expenditures that are currently required. And this, in the process, would have the additional benefit of creating a EU-wide safe asset. So we would essentially kill two birds with one stone, because we would not only address the climate problem, but at the same time also address another long-standing problem in the European Union, that is the lack of a sufficiently widely issued safe asset at the EU level. So let me close on this.
Good. So Marco, thank you very much. You give us an overview of this, very interesting new idea. But clearly, there is a lot of aspect that is, in some sense, that clearly, mostly because of time, you didn't have time to touch. There are some questions that I'm going, and I'm also inviting people to continue to ask questions in the Q&A. But, the first more general aspect that I think it will be interesting to know what is your view is that do we have in Europe really the political capacity to implement something like this, So this is one aspect that I would like that you start to touch. And then, I will go through all the questions that there are here that are more on details on how to frame, either the bond or how to implement the, let's say, this taxation, this, let's say, way to provide then funding for the transition.
This is a very, very good point. Well, first of all, there is as I said, an increasing, consensus among policymakers on the issuance of EU bonds for these kind of policies, not only, but also for defense. That's the first point. So in that is should make us a bit more hopeful than in the past that something like this could be done. But it is also important to reassure, of course, the electorate that the amount of resources that would be collected would be spent roughly in line with the kind of long-term contributions of the various countries to the resources that are used to create this fiscal capacity. In a way, this could be done by essentially allocating climate investments across countries on the same basis, on the same proportion, which they contribute not on a year-by-year basis, but over time to these to these bonds. So just to be clear, of course, a country like Germany, for instance, currently has a much greater level of emissions, and so would be than other countries, other things being equal, so would contribute relatively more. But to the extent they would also receive relatively more, would in the future reduce the level of emissions considerably, maybe more than in other countries, and this would in a way reduce the extent to which it would contribute to the issuance of these bonds. Now, it will be important to allocate resources to such a country based on what is the long-term contribution of the country to this scheme, rather than on the basis of the year-by-year contribution.
Okay, so let me go. There are questions. Maybe then you can also take a copy and interact directly later on, because we need to finish and then the next talk. But clearly, there is also concern on the substantial risk when you are doing this at the European level, in terms of really having the capacity then to monitor the implementation of this fantastic, plan. So in some sense, there is this question: what are the policy trackers to monitor disalignment and flag inconsistency? So are we sure that if things are done at the European level, indeed, it will be more efficient and there will be less risk of, misallocation of funding?
Well, there will be definitely fewer risks than there currently are, at least in some countries. For instance, if you look at the way the resources that are currently rebated by the European Commission to national countries they should be used for climate policy. They are not entirely used for climate policies, or at best they're very a relatively small part of them are used for climate policies. So currently we are in the situation where these resources are not used effectively for climate policies. We can only hope that actually having a kind of supervision by, for instance, the European Investment Bank with KPIs on the various governments that actually allocate resources based on the past track record would actually stimulate national governments to actually implement these policies in a much more effective way. But of course, no scheme is perfect, but I think it would be probably better than what we currently have.
Okay, so another question is that why the price carbon externality is not already solving the problem, and we need also then the government that is going to collect this money and fund it. So is the private market can provide in this case the funding for this. So Bundesbank has estimated that 80% of climate funding comes from firm internal sources, retained profit, without need for external funding on subsidies. So pretty much, is challenging, this is Tobias Berg, is challenging, on all this view of the need of having public money reallocated, that it will be more efficient if this money are reallocated by the public rather than done directly by, internally by firms.
Well, I mean, let me tell you the following. These models, these general equilibrium models, already take into account the impact of carbon taxes or carbon price on firms' decisions and household decisions. So to the extent that these models are well crafted, the extent to which firms react to carbon taxes is already taken into account. What is not taken into account is, of course, the extent to which, for instance, there are common utilities, for instance, the extension of the electric grid, which no private firm has incentive to do because it's a public good, and there are definitely some needs for public investments. So it's not as if we are not acknowledging that. That's the main reason why we're planning to have a carbon price, to push companies and households to emit less. But even so, there may be some, investment projects at which these firms and these households would not contribute unless the governments do it. I mean, that's
okay. So the last question, because then we are really out of time, is the crowding out effect. How much this type of bonds, Euro bonds, that are in a sense financed by the ETS revenues, are going to crowd out on one side climate green bonds and on the other side sovereign bonds?
Okay, to some extent this is going to happen, although one should take into account that national governments will have to issue less debt for these purposes, insofar as some of these activities are performed at the supranational level. The national authorities are going to require less resources, need less resources to face these spending needs. But some crowding out could indeed occur.
Okay, so Marco, thank you very much. There are still a lot of other questions, but clearly, we need to close here and to move to the next presentation that is, of course, also very interesting. I'm asking you maybe to look to the Q&A, and if you want, you can, in the meanwhile, also respond either online or be in touch with the people later on. So I'm very pleased now to move to the next presentation that is on, still related to climate risk and climate change, but is looking to this topic on a different perspective. It is corporate climate lobbying. We have Zach, that is professor of sustainable finance at the University of Zurich and a senior chair at the Swiss Finance Institute. He's associate editor of several journals like Review of Financial Studies, Journal of Financial Quantitative Analysis, and so on. And is well famous, you know, to work a lot on sustainable finance. He's contributing significantly to this field. So I'm giving the floor to him. Thank you very much, Zach.
Thank you, Loriana. I assume you can see the slides?
Yes, very good.
So thank you for the opportunity to be part of this. And, you know, it's an honor to speak after Marco. And, you know, it's also great to see that there are so many people also in the list of participants that have, you know, made some major contributions to the literature on climate finance. And so in a sense, this paper is, you know, themed within the area of climate finance, but as you'll see, it has broader implications for climate policy. And that's why we thought this, you know, paper fits nicely together with that of Marco. As a matter of fact, if you want, the paper basically that I present is about why Marco had to write his paper. Because this paper is about climate lobbying by corporations. And, you know, what is the link? Well, the link is that we all do know what to do in order to combat climate change. And that's, you know, by and large, a carbon tax or, you know, some version of this. But of course, we all know that this is not happening. We don't see this, and governments are not taking sufficient efforts. We are, and politicians on our behalf, are not taking sufficient effort to combat climate change in terms of regulations such as the mentioned carbon tax. Now, understanding why we don't get our act together is a first order question. And there are different explanations. And one important explanation I hope I can convince you about is that of lobbying, anti-climate lobbying by corporations. And this is what this paper is about. And I should emphasize that this is a paper that is joint work with Markus Leipold, who is also online, and a colleague here, and Tingye Yu, who is also online and also a colleague here in Zurich. All right, so most countries don't take sufficient effort and, you know, don't manage to implement policies to properly combat climate change. And as I just said, there is a wide concern in the media and the public, also among researchers, that in part that is because of obstruction by corporate lobbying activities. So it's obstruction of climate action through influencing of policymakers, regulators, to undermine, delay, or fully avoid pro-climate regulations or policies. Now, some people have labeled this type of activities as Scope 4 emissions to reflect that the adverse effect of this lobbying for climate change may be larger than these firms' direct Scope 1 or indirect Scope 2 and 3 carbon emissions. So now, what's the problem if you want to study corporate climate lobbying and, you know, more broadly lobbying and its effect? Well, the problem is that lobbying, almost by definition, takes place behind the scenes. So it's very hard to measure it. So a big challenge that the literature has is how to come up with good measures of climate lobbying, and in particular, whether the lobbying is anti-climate, anti-regulation, or pro-climate. Now, what's also interesting if you think about corporate lobbying is that it sometimes actually collides with public statements on how firms plan to fight climate change. So, for example, ExxonMobil, Glencore, Stellantis are just a few examples of companies that made public statements to become greener, for example, through net zero pledges, while at the same time and in silence lobbying against climate action. So therefore, there is often a misalignment between how companies publicly talk about climate change and what to do about it and what they actually do in silence. Now, this matters for investors, and that's relevant for the paper because as a finance scholar, of course, I look at outcomes that are relevant for investors. And it's relevant for investors because we have seen that in the 2022 proxy seasons, manifestations of this misalignment of public talk and silent lobbying was one of the key issues that was raised by activist investors. So, of course, there's one pending question that I need to provide you an answer to, which is, does lobbying actually matter? Now, there is plenty of evidence that corporate lobbying is not a sideshow, but has real effects on climate action. And I will not give justice to all these papers, by discussing them in a couple of minutes here. So I refer you to the papers that I'm mentioning here in brackets, where you see all the details. But basically, they provide very convincing evidence that through different forms of lobbying and influencing policymakers, for example, in 2015 and 2016, the US Clean Power Plan, which contains standards to combat climate change by reducing emissions, has basically failed to be implemented. Now, if you're interested in this, there's one piece of evidence kind of illustrating where the problem is that has been basically caught on video. And it's a video that illustrates, and it was basically a clue by a journalist, how an ExxonMobil lobbyist said on video how the company fought climate science through set of groups influencing scientists on how they report on the challenge of climate change, and how the company also targeted senators to weaken President Biden's climate proposals. And you can watch the video online to see all the ins and outs of this. Now, again, this is against the fact that ExxonMobil in public claimed that they would take action to combat climate change. Well, again, this did not align with what they were actually doing in silence. So let me tell you what we're doing in this paper. We basically do three things. Step one, we quantify the dollar amounts of corporate anti and pro-climate lobbying. We identify the largest corporate lobbyists on the anti and pro side. And we also study what their motives are. Second, we establish how climate lobbying relates to corporate business models, things as carbon emissions, in the paper, not in the slides, also whether firms that produce energy from renewable sources or coal, oil and gas. And we also study how it relates to green innovation. Step three, we document whether how climate lobbying is priced in financial markets. And I'll explain you later why it might be priced in financial markets. So just very briefly, it could be priced because investors may perceive the lobbying, especially the anti-lobbying, as being risky for reputational and transition risk-related reasons. I'll explain them later. And therefore, they may ask for a compensation when investing in stocks that do a lot of especially anti-lobby. Like Marco's paper, we also have put the paper on SSRN, and you can download it and see all the details, and in particular also see the large related literature that has provided lots of important insights already on that topic. However, not explicitly on the three questions that we are addressing here in this paper. So a key question is, how do we measure corporate lobbying? Now, two steps. Step one, we measure whether firms are doing climate lobbying. They do lots of lobbying on all kinds of topics. And the question is, how can we identify whether they do climate lobbying and how much climate lobbying expenses are associated with it? So in order to identify climate lobbying, we look at lobbying reports that firms and lobbyists that lobby on behalf of firms have to file by law in the United States. So this is a paper that looks at US lobbying. So we look at these lobbying reports that are filed on a quarterly basis. And now in these lobbying reports, firms have to enumerate items, different items on which they're lobbying. So what we do is we're automatically, using the help of computers, of course, we're reading these descriptions in these items, and we measure whether a predefined set of climate-related keywords appear in these item discussions. So there may be 3 or 4 items, and so we identify whether in a specific item there is lobbying related to climate change by identifying whether these descriptions, for example, contain words as like carbon tax, climate change, global warming, and the like. So what is important also is that we're not just looking at these keywords and whether they appear there to assess whether a specific item, lobbying activity, is related to climate change. We also look at the bills in words and keywords, or bill codes, I should say, that appear in these items. Because, of course, very often companies lobby on specific bills. Anti-climate bill, pro-climate bill. So we also identify whether in these descriptions they refer to bills that we identify as being climate related. Now, a key element, and I briefly mentioned this, is that sometimes firms are not referring to the specific bills in terms of US Clean Power Plan bill, but refer to very abstract bill codes that by themselves are hard to decipher unless you have the intel and look up what is explicitly referred to. And that will be relevant in some of the things that I'll discuss later. Okay, so the bottom line is, in step 1, we see whether in these items that discuss the lobbying, there are keywords or bills related to climate change, and then identify this item as climate related if some of these keywords or bill types appear. Now then, what we do is we quantify the amounts of climate lobbying by allocating the total lobbying expenses that are listed in the report across the different items. And of course, we don't know when there are 3 items, how much is spent on each one of them, because firms have to not disclose this. So we basically then would just divide the total amount, if it's 100,000, by 3, and then have the 33,000 if there's one item related to climate lobbying, kind of identify the expenses relating to climate lobbying. Now, step 2. At this point, we don't know yet whether the lobbying is anti or pro-climate, which of course is an important dimension we want to capture. So here we follow an earlier and very nice paper that you should also have a look at by Sung-Young Kwon, Michelle Laurie, and Michela Verrado. And so what they do, they look at environmental lobbying, is that in order to identify pro or anti environmental lobbying, they calculate whether a firm's lobbyists contribute primarily to the Republican or Democratic Party. So if a firm's lobbyists themselves privately donate primarily to the Republican Party, then the assumption is that the firm and its lobbying, climate lobbying, is probably anti-climate, and vice versa if it's pro-climate. So we follow their approach, but we make one major deviation, which turns out to be very important in identifying climate lobbying. Again, they do something different. They look at environmental lobbying more broadly. And that is, we are looking not just at lobbyists, but also corporate executives. Right? So if we have a company where we know they did spend money on climate lobbying, if its executives donated primarily, and in almost all cases it's full amounts, to the Republicans, then we classify that company's lobbying as anti-climate. If they donate primarily to Democrats, we classify it as for climate lobbying. And in the paper, if you think there are lots of steps, logical steps in between, whether Republicans are really, more anti-climate compared to the Democrats, and whether it's really not that executives, spend on all kinds of firms and so on all kinds of parties and so on. I would discuss all of these steps in the paper, and you'll see that this is a pretty good way a pretty clean way of identifying whether the lobbying is pro or anti-climate. Okay, so we look at the description and whether the companies that do the lobbying are led by executives or helped by lobbyists that primarily donate themselves to the Republican or Democrat Party. So now let me get to the results. Let me start by providing you some descriptive evidence. Across all the firm years that we have, we start in 2001 until basically now. If you look at all the firm years in the sample, and our sample, base sample here is all for all those firms that do some lobbying, right? Some lobbying. It doesn't have to be climate, all right? And so all firms that do some lobbying, out of all these firm years, if you aggregate this at the firm year level, we find that in 10% of the firm years, there's some anti-climate lobbying expenses. And in 7.4% of firm years, there are some pro-climate lobbying expenses. Now, how big are the amounts? Within the set of firms at the intensive margin that do lobby on climate, we find that the average company spends about $300,000 a year on anti-lobbying and about $160,000 on pro-lobbying. Right? So there's significantly more anti than pro-lobbying. Now, this measure of lobbying varies a lot over time. So here we report the aggregate amounts of lobbying anti and pro per quarter here across our sample. And so what you see is that in the initial years of the sample, climate and climate lobbying and regulation was not an issue that firms cared about. They lobbied on different things. Then there was a sharp increase in lobbying, in kind of line with a surge in climate legislation, such as the American Clean Energy and Security Act in the 2000s, 2010s, and so on. There was a decrease again in lobbying over the years later. Then you see, pretty little climate lobbying expenses during Trump's administration because, whatever you did, it didn't change his mind probably because he had very strict, categorical views on, how to think about climate change. But then more recently, during Biden's administration and, the more stringent climate regulation proposed and, the stronger, efforts in supporting climate action, there was again a large increase in lobbying, especially also from the pro-climate lobbying side. So then in the next step, let me show you what are the major anti and pro-lobby companies. In the paper, we have it also by sector if you're interested in this. So what do I show here? I show here the top 50 firms in terms of total amount of anti-climate lobbying across our sample period from 2001 to basically today. So we aggregate all the amounts that these companies spend and then rank them by total dollar amounts. So you see the top 5 firms, with the top firms spending more than 80 million in aggregate across the sample period, are Southern Company, Utility, ExxonMobil, you all know, Chevron, you all know, BP, and American Electric Power, as the name suggests, also a utility. Now, interesting, these companies we identify also as spending some modest amount on the pro-climate side, right? But of course, nothing in relation to the anti-lobbying amounts. So we do the same with the firms that do pro-lobbying. Also here, aggregate the amounts across the sample and rank them by total dollar amounts. Number 1 is PG&E, Californian utility, followed by GM, interestingly, all right, probably in support of, regulation on, electric cars and so on. Calpine, Coventry Energy, and Microsoft. Now, I mentioned this earlier. I mentioned earlier that in these lobbying descriptions in the items of the lobbying reports, we found that increasingly firms try to refer not to specific bills and not use specific climate language, but instead they try to camouflage their lobbying by instead referring to these abstract bill codes. So rather than saying we lobby, spend money to avoid the passing of the Inflation Reduction Act or so, they say we conduct lobbying in relation to bill code H.R. 5376. Okay, so clearly they try to do this to hide attention when it comes to the type of lobbying they're undertaking. And in the paper, we have a more detailed analysis, and we show that this is in particular an issue of the recent year. And we show that in particular, it's the firms that engage heavily in climate lobbying that try to camouflage it the most. It's not just the anti-climate lobbying firms, but it's also the pro firms. Now, probably reflecting this general, more broadly defined trend in the US of a lot of backlash from the anti as well as pro climate side when it comes to companies. And here's an example. In 2009, ExxonMobil allocated 30 million to anti-climate lobbying based on our classification. Now, in 2009, 63 of this can be detected explicitly in the lobbying reports using keywords, carbon tax, global warming, whatever it be. Now, by 2022, this percentage dropped to just 18%. All remaining anti-climate lobbying expenses that we detect can only be detected using these more abstract bill codes. Anti-climate lobbying in aggregate for that company also fell. But what is interesting for us, of course, is the percentage. And as we argue, it's perhaps in response to this trend that investors actually increasingly worry about a lack of transparency in climate lobbying, as I'll illustrate here also at the end of the presentation for one major investor that has now expressed this explicitly in its climate change expectations for portfolio companies, the concern about a lack of transparency in corporate climate lobbying. So very briefly, I mentioned we're looking at how lobbying relates to the business models of companies. So two main results here, and I'll put a regression table so that you see that despite all these pictures and words, we also do some proper empirical analysis. So result number one: firms that spend more on anti-climate lobbying, and here we use the intensity we scale by assets to account for size effects, they have larger carbon emissions, be it total emissions or be it carbon intensity. Second result, we find that those firms that spend more on pro-lobbying, they file more green patents as a ratio to total patents, and they have more discussions on green innovations in their earnings conference calls. Now, a key part of the paper, as I mentioned, is try to understand how this lobbying activity relates to stock returns. So let me start by just providing you the pure empirical evidence, and then I'll provide an interpretation of what we find. So here's what we do. We take stock returns from February in a year to January in the year after, so that's T+1, and relate it to the amounts of money spent on anti and pro lobbying, as well as the difference, because some firms do both, as of the year before. So we start with February because it takes a couple of weeks until this information is available to markets, for markets to price that information. And then we are basically splitting the sample because it turns out that in the early years of the sample, where also climate issues were not really an issue that investors were much concerned about, there is no link between lobbying and stock returns. But there is a strong link between anti-lobbying, not pro-lobbying, and stock returns in the period from 2010 to the end of the sample. So what we find in these regressions, which, by the way, follow this characteristics-based approach that you may have seen from Patrick Bolton's and Marcin Kacpaczyk's papers and others, what we find is that in that second sample period, firms that spend more on anti-lobbying have larger stock returns. In terms of amounts, if you increase anti-lobbying by one standard deviation, it comes with 0.36% higher monthly returns or 4.3% annually. And let me just note that apart from the control variables we include here, like the general lobbying intensity towards Republicans and Democrats and all kinds of firm characteristics, this also holds after controlling for carbon emissions. Now, what is the interpretation? And before I go to the interpretation, let me give you one other piece of evidence. We do not find that lobbying is associated with higher earnings, or earnings surprises in particular, and that's going to become relevant in a second. Right? So, because now we have to interpret the evidence. And as you know, if you work in finance, there are basically two explanations on why there could be a link between a variable and stock returns. Interpretation one is it's a risk premium. Interpretation 2, it's mispricing. So I already told you that we don't find that firms that spend more on anti-lobbying and have higher returns have higher earning surprises. So this speaks against this effect reflecting mispricing. The market not understanding the value of lobbying, right, of anti-lobbying, you could say there is value to it, and therefore it's not pricing into the stock the value of the lobbying and not being able to forecast the value of it in terms of effects on earnings, and therefore we see earning surprises. That's not what we find. So we don't think that the mispricing channel is what really explains the results. Instead, what we believe is that it's a risk premium channel. We believe firms that spend a lot on anti-lobbying are seen as more risky by the market and therefore in turn have to deliver higher returns. This aligns a little bit, and you have seen this maybe, to the work by Martin and Patrick, that there is a carbon risk premium, and to some of my recent work where we show that there's also a biodiversity premium. Firms that have a more negative impact on biodiversity also have to provide a risk premium to investors. Now, it's not just academics making this up. And to show this, there is an interesting article by Sustainalytics, one of the big 4 rating agencies, so the one that really matters for investors in terms of market share. And so what they write is, they write that in their view, anti-climate lobbying can constitute an investment risk by A, damaging trust in firms or leading to name and shame actions, a reputation risk, and B, by leading firms to not adjust business models fast enough in the hope that lobbying succeeds. Transition risk, right? So Sustainalytics, as a major provider of assessing ESG risks, believes that if you do a lot of anti-lobbying, it increases your risk. So our results are consistent with investors pricing that risk and demanding a risk premium from investing in high anti-climate lobbying stocks. Now, let me get to the last result. So if you believe that this risk channel is really driving the results, then you should at some point also see an equilibrium that if there is news to the risk, that this should affect asset prices. And so we do event studies in which we exploit 2 very specific but relevant in our context shocks arising from 2 events and being related to climate lobbying. First event, when Senator Lindsey Graham, Republican, dropped his support for the Waxman-Moore cap and trade bill, which was a very, very important bill, but eventually didn't pass. It would have, for the first time, basically, put in a proper US-wide cap and trade scheme. So when his support dropped, because he was really instrumental here, it was clear, and that's also what the media writes, that this cap and trade bill would not pass. So we find in an event study in the days around this that it was those firms that did a lot of anti-lobbying that were increasing in valuations, and those that did a lot of pro-lobbying decreasing in valuation. So therefore, in a sense, this risk premium channel, because here now the risk goes down, would predict that the valuations of these stocks go up, the anti-stocks, and therefore the risk premium, the expected returns go down. And that's exactly what we find. Now, there is a second event, which was the passage of the Inflation Reduction Bill, which also came as a surprise if you read the media, because Republicans changed their mind. And so we find here exactly the opposite, that when surprisingly the act passed, which, as you know, is making progress on climate action side, that the anti-lobbying companies lost in terms of market valuation and the pro-lobbying firms gained. So therefore also here, the lower valuations of the anti-lobbying firms would kind of in equilibrium also then lead to higher expected returns. We're not saying these are the only events, of course, driving this, but it's kind of suggesting that there are these events that kind of help us explain why this premia do arise. So 5 takeaways. Firms spend on average $300,000 on anti-lobbying, about $160,000 on pro-lobbying. Recently, firms try to camouflage their lobbying activities and You may see this on my whiteboard behind me. We're currently still working on doing more and adding more to this paper because we believe this is first order. Large anti-lobbyists have more carbon-intense business models and face more climate-related incidents in the future. Haven't shown you that, it's in the paper. Firms that spend more on anti-lobbying earn higher returns, and we believe it's a risk premium. And they're consistent with this. Their stock prices went up when the cap and trade bill failed, and down when the Inflation Reduction Act was announced. Now, again, and this is still a cliffhanger from the beginning, this is relevant for financial markets, and investors care about lobbying. So this is from the climate expectations of Norges Bank Investment Management. As you know, the oil fund, and a major investor, only 1.5% of stocks globally. And so in its expectations of portfolio companies, 9,000 or so they say, companies should align their lobbying activities with the objective of the Paris Agreement and address membership of trade bodies or associations that is or may appear incongruent with the company's climate change policy. And now this is about the camouflaging part, they also write in their expectations, companies should be transparent about where they advocate for specific policy and legislative support. Be transparent and not camouflage. Thank you very much for your attention.
So Zach, very nice, very interesting, and I really like, and I'm sure that everybody that listened were very interested on your result, but we want to understand what are the policy implications then. So what do you suggest, given that you show that they may have an impact and they're spending money on this? Clearly, it is interesting the dimension to touch that is having an impact on the stock return, but in at least if we want to give suggestion, on how to make our world better. So what are the policy implications?
This is a great question, first of all. So let me try to, give an analogy. So we know that firms that have larger carbon emissions also have to deliver higher returns. And because there is such a carbon risk premium, investors are engaging companies to reduce emissions. So even if there's no carbon tax as of yet, carbon prices not being high enough, some investors, way too few at the moment, but are engaging investors because they see that's a risk and they want to address the risk. And as a matter of fact, if they're successful with engaging and reducing the risk, they also generate value for them, right? Because then, the risk goes down, the valuations go up. I have a paper forthcoming in the Review of Finance where we show exactly this. So therefore, I wouldn't say, let's immediately jump and say we should forbid this. No, because we're also not 100% sure what is the right form of lobbying. So we don't want to prescribe what to do. But if investors perceive this as a risk, then there is value in engaging companies on this, right? And try to get them more transparent in terms of how they disclose about the lobbying, and if these investors believe it's detrimental to how they think about climate change and climate risks, then also engagement over reducing this, right? And I think also here again the analogy to carbon emissions, we believe that we've made a lot of progress, not enough, but a lot of progress by getting more firms disclose on their carbon footprints, because we believe from an investor perspective that this is material for stock markets to price the risk correctly if we have the information. It's also relevant for their financial stability. If you see some of the reports that that you or your predecessors, right, for example, in European Systemic Risk Board have been writing about, where the argument was, in order for the risk to be correctly priced, we need more information. So also there, I would say, if there is something, to do on the regulatory side, then it's, to help foster transparency about this. And yes, there's already some of this going on in the US, but maybe not enough yet, right? And, the ExxonMobil example, it was detected by journalists. It was not because the firms were transparent about what kind of lobbying activities they did with respect to scientists and so on, okay? But I have a lot of investors enacting.
Good. So let me go through the question. There are some questions. One is, you are in some sense measuring largely the role of lobby played by firms. But, you know, in this framework, there are also institutional investors like banks, like mutual funds, and so on. Do you see, or do you have any information on this other type of actors in the economy that may have also an incentive to lobby for similar reason that this firm?
This is a great question. So now we can, you know, look at, you know, within our sample. I'm just trying to look a little bit at the you know, industry distribution. You know, to what extent we can identify from what we currently do. You know, the role of the financial sector, and you know, I'm just glancing through it. You know, it's not in the top 10 as I see it in terms of anti-lobbying, right? But you know, certainly, you know, this analysis you can also apply to banks. But yes, I mean, you know, going beyond what we do and kind of you know, inferring the lobbying from our data, which is, by the way, from open secrets, if you're interested in this, so everyone can have access to this. And we also want to make our measure, by the way, available for other researchers to use it. But what you, of course, can try to do is you know, try to you know, zero in more carefully into the banking associations, in the lobby organizations that you have in different you know, countries, and you know, try to collect that type of data, right? It's a little bit like the trade unions I was mentioning. So let me encourage you to do this, right? Because I think we all agree that the problem is so huge and the evidence so little that we need to devote much more time on looking at this. And you know, every paper here has a payoff, right? Because it hopefully helps in tackling this great challenge.
Yeah, and related to this, you know, clearly you look to the US, but if you would like to do the same analysis for Europe, what are the challenges you will face? Do you have similar data available, or how is the situation?
So to my understanding, it's not as you know, standardized, easy accessible as in the US. At the same time, I also think that in the US, of course, there's much more polarization than we have it here. Right? So I don't think you're going to get the extremes in Europe that you have in the US. That's not to say that it doesn't matter. And I was mentioning, you know, Stellantis earlier, right, which you know, is of course a European firm, and you know, headquartered in Amsterdam. So you know, you can also collect this, but you know, just thinking out loud, right? I mean, maybe here one has to primarily look at what documents could be available in Brussels, right? And you know, also frankly speaking, from my own experience with the you know, process in Brussels, where I was, you know, once in a while participating, or asked to participate in, you know, in processes where they require feedback from academics and also from practitioners, I sense that there is a lot of subtle lobbying going on, right? It's just anecdotes, right? But there are anecdotes of cases where it was actually the lobbyists, the companies that were writing the proposals. And, you know, also I was, you know, maybe some of you too are involved with this study on short-termism in financial markets that the EU came out with a report, and then ECGI in particular reacted. And now, whatever you think about the direction of where it's going, but it's largely based on a consulting report, and this was a terrible consulting report, right? I mean, it was going, you know, not, you know, totally anti-ESG or so, but you know, it was just not well done, right? And so therefore, probably what could be a good avenue to look into is this consultation process we have. And just to advertise, you know, people looking into this, we have at the moment a hugely important process, because there were proposals on ESG data regulation, on regulating, as you know, Loriana, ESG rating agencies, right? And so I do believe this is first order, because trillions of assets are invested based on ESG ratings, and we want these ratings to be true and fair and transparent. And currently we do have the proposals out there, so I'm sure there's huge amounts of lobbying going on. And so we should also do our lobbying and express our views.
Yeah, I want to add to this that ISMA is out with a more broad, let's say, call for a suggestion on how, you know, to collect data in general about sustainability, not only for how to regulate ESG rating agencies. So, you know, and clearly in most of the case, to this call for proposal are the lobbyists, the one responding, and maybe us can do something. Indeed, here at SAFE, we are working for providing some suggestion at ISMA. The deadline is the 15th of March, so it's not so far. There is the last question, because the time is running, that I think is also that is coming from the Q&A. That is, can you please explain to us better what is the role of the shareholders in the decision of the firm to do lobby? Because who are really taking the decision in the firms based on your understanding? So are the shareholders first aware that their company are doing anti or pro lobby for climate? And who are at the end taking this decision?
I think it's an important question. It's going to be hard to answer this very quickly, but yes, I mean, first and foremost, if you look at the US, right, if you take the business judgment rule and the way that corporate law is interpreted, and I'm not an expert, it's first and foremost, of course, the management, right? But if the actions of management don't align with the stewardship views of the owners, right? Then it's of course the owners kind of indicating this and making statements that suggest that we believe that this is a material financial risk and that you should incorporate this, right? And that's how I interpret NBIM's guidelines, right? Because they think that's why they make this guideline, that these things are financially material. Right. So even so, of course, and that's now the buzzword that we've been hearing again and again, and our shareholders don't want to be prescriptive, right? But if they believe that because of the lobbying there is a material financial risk, then it's the shareholders who should step up and intervene and use the engagement process, the proxy voting, and what is it in order to address this.
Yeah. Okay. Very good. So I think that now, our time is over. So I want really to thank you, Jacques and Marco, for this great presentation. We are learning a lot. And, clearly, if people want to be in touch with you and have other questions, that I'm sure there will be, they should contact you both directly. And both the papers are in SSRN. So I'm inviting everybody to read it carefully. So thank you very much to everybody. Bye-bye.
Thank you, Loriana.
Thanks, Loriana. Thanks a lot. Thanks.
Well, thanks, CEPR and the RPN project. Good.
Bye then.